Okay, so we have some good and bad news from the economic data that came out this morning. The good news is PCE came in lower than expected. We kind of already expected this though, because Fed Waller told us it could come in around 0.14% and thus get rounded down to 0.1%, which is what happened. We came in at 0.1% for core month over month. The estimate was 0.2%. The bad news is personal income came in about 50% lower than expected, only coming in at 0.2% month over month versus the estimate of 0.4%. And the other bad news is personal spending month over month that came in at 0.2%. The expectation was 0.3%. Incomes lower than expected, spending lower than expected, but inflation down more than expected. We also got final numbers for the Michigan consumer sentiment that actually came in better than expected. Headline number came in at 70.1. The forecast was 69.3, up from 67.9. The last update that we got. Consumer expectations jumped to 74.4 versus estimates of 73.0, and Michigan current conditions came in at 63.3 versus estimates of 62.9. So across the board, you also beat on Michigan consumer sentiment. Now, Fundstrat's Tom Lee makes an interesting point in a new note out to clients today. He says, quote, "The largest drop in margin debt since last year speaks to investors waiting to deploy capital after the election results. Lots of firepower on the sidelines. The last time the S&P 500 made 42 all-time highs in a calendar year without margin debt at an all-time high was never." Oh yeah, it's different this time because it's different every time. And you've actually seen the largest de-risking since October of 2023, where margin debt actually declined about $14 billion in August, down to $797 billion, down from its prior peak in October of 2021 at $936 billion. So yes, there is the capability for a lot more debt and a lot more margin to push valuations even higher if people want to do that. And just so everyone's aware, this whole not wanting to invest before the election thing has nothing to do with who wins or not. It just has to do with uncertainty. And I guess in a perfect outcome, you would want things to be split. So Democratic, Republican president, you would want the opposite for the Senate and the House, or at least one or the other. You don't want a full Republican sweep. You don't want a full Democratic sweep as far as the market's perspective. As long as you get a mixed government, then that's seen as not much is going to change, and that's seen as good for markets because markets don't really like change all too much. Now, markets are extending the decline into the late trading hours, mainly following this news. Apparently, there is videos surfacing of multiple buildings being destroyed. Oh, that's really loud. And apparently, the leader of Hezbollah is missing. And this is sparking some concerns that maybe he is no longer here, and that's, well, potentially a driver to a larger conflict. Now, take a listen to this clip that says, "We expect a weak labor market with only 70,000 jobs added." If we get a number next week of 70,000 jobs, markets are going to tank on that. Because if you factor in the revisions, you would actually be negative if the revisions were just average for last month. If we only added 70,000 jobs, that's rough. That's really rough. So I want you guys to take a listen to this, and I will also share all of the other data points that we have next week, because next week is a critical week for markets and for the soft landing thesis that investors are holding on to.
I asked this earlier. I'm going to ask you the same question. What's at stake for this PCE report? We've heard from the Fed. They believe that inflation's moderating. They like the pace. They like the trend. They're really focused on the job market. So what's at stake?
Yeah, I think we will confirm that inflation is just continuing to slow with this PCE number. Of course, when the PCE data come out, it's not necessarily a big surprise. We know most of the price inputs from CPI and PPI that came out a couple weeks ago. This should show another benign monthly increase. We're expecting a 0.2% month on month. That's a very good, around a 2% annualized kind of pace. And I think that does just keep the focus on the employment data.
Benign is an interesting word. A lot of people are using that nowadays. Sometimes we get inflation reads, we call it benign. Sometimes we talk about the rate situation we're in with bonds. Some people say that's benign. I want to look ahead to something else that may be a bit more volatile. The jobs report coming up just a week from today. So how important is that, not only for the markets, but for the Fed?
Yeah, I would not use the word benign to describe the labor market necessarily. We do think that this is a weakening labor market. We've seen that more clearly in the jobs reports the last couple of months. Of course, we've had a much more rapid rise in the unemployment rate really over the last 4 or 5 months, rising 1/10 on average each month. Payroll job growth has now started to slow and has been revised lower every month. We think we'll see a continuation of that next Friday. We're expecting a relatively soft 70K jobs added in September, expecting the unemployment rate to tick higher. And that is a pretty uncomfortable report for the Fed.
All right. I want to hit on something else that I'm not really sure the Fed looks at. You tell me. The recent rise in commodities following that Chinese stimulus. That rise in commodities can also often be inflationary. Is that something that you think the Fed is monitoring? Will that at least potentially influence their decision coming up in November?
Yeah, I don't know if we'll see the impact of that as soon as the November decision. Of course, we are watching the inflation data. It would be inflation that would derail future cuts. At this point, we are of course coming from a place of very high inflation, but we actually have seen some shipping costs rising this year, input costs rising, and it just seems like the U.S. consumer will not accept further price increases. So even with those input costs rising, we've still seen goods prices falling, for instance. This does just seem like a soft demand environment, and that's what is leading to slowing inflation. All
right, I want to get to your Fed forecast. So you're forecasting a 50 basis point cut for the next meeting coming up in November, and then after that, 5 quarter-point cuts. In your mind, does that mean that if we see that path, is that inflation continuing to moderate and the job market being soft? Is this us hitting the soft landing? I mean, this forecast, what's the scenario for the economy, for the markets, for the job market, if this does play out?
Right. I would say that even the risk to our forecast is that the Fed could be front loading even more of this easing, because we do think that is coinciding with a further weakening in the labor market. And it does seem like Fed officials are just going to be pretty inclined to get back to at least closer to a neutral rate as soon as possible. The issue is we don't quite know where neutral is this time. So maybe as you're front loading some of these big cuts, at some point you want to go a bit slower and feel out where a neutral rate might be. But if it does look more obvious that the labor market is slowing, I would say the risk to even our forecast is that the Fed is cutting more larger cuts and cutting a bit faster.
Oh, so you're saying the risk of the forecast is we might get a 50 basis point cut in December as well?
Yeah, I can absolutely see that. We'll see the next 2 employment reports. Of course, we're going to get 2 employment data reports before the November decision. I wouldn't even be surprised if they could go a 75 in November. Of course, we're penciling in 50 basis points, but it's just going to be very labor market data dependent.
Damn, if she is correct, you don't want to be in equities. She's saying that we could actually see a 75 basis point rate cut in November. If we get a 75 basis point rate cut, even another 50 basis point rate cut, yeah, the labor market is not going to be in a good place. And the markets are pricing in a 50 basis point rate cut for November, which is already assuming more weakness on next week's jobs report. And I think that's a pretty accurate take. Now, let's start off on Monday of next week. On Monday of next week, we don't have much. You get Dallas Fed Manufacturing Index. Now, the Kansas Fed and the Richmond Fed Manufacturing Index has missed big in the past week. Now we're going to get the Dallas Fed Manufacturing. Does that miss big again? If it does, the markets are going to start paying a little bit more attention to manufacturing and really factory jobs that could start to be lost in pretty big numbers. You will also get these Chicago PMIs. That will be important. All of that data coming out in the early morning hours. And then you get another speech from Fed Jerome Powell. The last speech we had this week, we didn't get anything from Powell yesterday. He did not comment on economic activity, nor did he comment on monetary policy. So that was a nothing burger. We could get another nothing burger next week. Now, Tuesday, you're going to get the ISM manufacturing PMIs. These things are expected to come in pretty bad at about 47.2. 0.2. It could actually come in lower than that. We're going to get another employment reading out of that, some other statistics that go along with it, and I think markets will be paying attention to it. JOLTS job openings is going to be another big catalyst. Last month we were at 7.67 million. We're expecting 7.65 million. So slight weakening on the job openings front, but from what I'm seeing in the actual economy and in the job market, you could probably come in well lower than that. And as Jerome Powell said, they don't want to see any more job openings come down, because if job openings do come down, then you're going to start raising the unemployment rate even more. That's not really something the Fed wants at this point. You will get ISM manufacturing new orders, prices paid, construction spending, employment, Dallas Fed services, all of that coming out at about 10 o'clock in the morning on Tuesday. Bunch of Fed speakers as well throughout Tuesday. Heading into Wednesday, bunch of Fed speakers as well. Couple bond auctions here and there, but that's pretty much it. Thursday, you're going to get ISM services PMI. Now, manufacturing's been in a bad place. It's getting worse. You don't want to see services start to get worse right now. If services start to get worse right now, that would be a problem. Anything under 50 is negative. Anything above 50 is positive. We are expecting 51.5, so to still be in positive territory. You will get factory orders month over month, services business activity, service employment, service new orders, and services prices paid. All of those will be important. And a speech from Fed Bostic as well Thursday in the morning. And then Friday is going to be your big report. Non-farm payrolls for September. Markets are expecting 145,000. So if we get 170,000 or any number close to that, really any number under like underestimates is going to be bad, right? You want to come in at like 150, 160. But if you even come in at like 130, Wall Street's going to freak out over that. Anything close to 70,000 jobs, and you could have a big decline for Friday. And that would probably start a larger correction in markets, I would think, with certainty. So non-farm payrolls next Friday, vitally important that comes in better than expected. Unemployment rate is expected to stay the same at 4.2%, although we did drop from 4.26% down to 4.22%. So the drop we really had last month was minor, okay, if you actually look at the decimal point. If you do see a rise back above 4.25, that's going to get rounded up to 4.3 for the headline number, and that is a potential risk that we should be open to. And another rise in the unemployment rate on this headline, again, rounded number, is going to be seen as bad news, okay? You don't want to see the unemployment rate rise or non-farms miss when markets are at all-time highs and the Fed just cut 50 basis points. That's the last thing you want to see. So I am a little nervous heading into next week when we get all of this data. It just doesn't look great. I think the risk is growing that we get downside surprises, not upside surprises, especially with what we're seeing in the labor market. Then again, I think the economy is somewhat going to hold up from now until the election, at least on the government data. You're going to see it hold up. I see a much more deteriorating situation in real time. But, that's kind of the worst thing that could happen during an election year, is to have the economy going down the poop chute. So I don't think anyone over at the Gov wants that to happen, or wants it to look like that is happening. Let's differentiate there. Now, here on the day today, I have to say things do look pretty good. The RSP, which is the equal weight S&P, is up 0.55% today. Even though the S&P itself is in the red, it's really just being dragged down by big tech. Nvidia's down 2.5%, Microsoft down 0.6%, Amazon down 1.7%, Meta's fluctuating between barely green and barely red. Google's up over 1%, Apple's up a third of 1%, but overall big tech is a negative drag on our markets, where you're actually seeing the Russell 2000 up 1.2% today, which is massively outperforming something like the NASDAQ, which is down a third of 1% today. S&P, again, slightly in the red. The Dow is also outperforming, up 0.57%. And as I've said here on this channel, if you want to be bullish on markets, you probably don't want to be bullish on the S&P or the NASDAQ, not with the expectations that we currently have. you probably want to be bullish on the Dow, on the Russell, really cyclicals and interest rate sensitives. Okay. Now, if we go into a recession, small caps are going to do very bad. Cyclicals are going to do very bad. The S&P and the NASDAQ will see a relative outperformance. Like if the Dow falls 20%, for an example, the NASDAQ might fall 15%. Or 16 or 17%, a relative outperformance, although you would see everything kind of do bad at that point. But in the scenario that we do actually see a soft landing, I think the vast majority of the upside is in cyclicals and small caps. So along that playbook, you're actually seeing that happening today. So I would say the markets in internals are actually pretty good today. The VIX, though, is up 2.3%. There's definitely some hedging that is taking place. The percent of stocks today trading above their 50-day moving average is up to 67.72%. You do have about 5.4% of stocks out there on our markets actually breaking above the 50-day moving average today, so that's a pretty good sign. CNN's fear and greed indicator yesterday was at 71, getting pretty close to extreme greed. Today, falling down a little bit to 68, still on the higher end of greed. And if you look at the 7 different indicators that make up the fear and greed index, market momentum is greed, stock price strength, extreme greed, stock price breadth, extreme greed, put and call options, extreme greed, market volatility is neutral, safe haven demand is fear, and junk bond demand is in extreme fear. Now, it's actually interesting. Nick Timmerhouse points this out on his X account. He says, given Thursday's BEA revisions to income figures, the personal savings rate for July has now been revised up by 2 percentage points to 4.9% from a previously reported 2.9%. This is the personal savings as a percentage of disposable personal income. Look at this. Before the revision, you were at 2.9% and you got way revised up, like way higher. Is that actually accurate? I don't think so, but maybe. Nick Timmerhouse also writes this article that says lower rates don't guarantee a soft landing, though they certainly improve the prospects of achieving one. At issue is the average cost of debt quite possibly still rising, and the marginal cost of debt, which is falling now that the Fed is cutting. So really, just for translation, it says for some households and corporations, high rates didn't translate into translate into higher rates. Borrowers simply chose not to borrow. Think of a homeowner declining to stay put. Larger amounts of low rates, fixed term debt created buffers that may have diminished the transmission of tighter policy, and they could similarly diminish the transmission of easier policy if the economy needs it. Basically saying, just as an example, if people just stayed in their homes with their low interest rates at 3%, the Fed cutting rates, lowering mortgage costs is not really affecting that many people because we're not on adjustable rate mortgages, for an example. So how much effect is the Fed cutting rates actually having? This is something that I've talked about here on this channel, that perhaps nowadays a 50 basis point rate cut is only like a 25 basis point rate cut due to some of the locked in long-term debt that is, has been very low via the 15 years of low rates we had before the Fed started raising rates in 2022. But even also psychologically, right? People are more financially cautious now, and people are trying to have better finances after the Rona. I think a lot of people got a bunch of money for free via the government, right? Whether it was unemployment or stimulus checks or both. And then they ran through all that money, as we can see from the data. And now people are trying to make the cautious financial decision. Just look at how many more people are investing in markets today, in stocks today, right? There is to some degree more financial caution out there. And just because the Fed cut rates 50 basis points doesn't mean that people are going to jump out and start spending a bunch of money. Now, I think at a certain point, when the Fed does a lot of cutting and when rates are materially lower than they are today, I think that will spur more spending activity, but not with rates at current levels. But again, that's just my personal opinion. Let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.